In the second part of this lecture, we will introduce a mini case about IPO pricing and allocation of shares. So, how can the investment bank set the final offering price or the stock price? Let me explain this by giving a simple example. Say one company wants to go public by selling 5,000 shares. The financial advisor used two valuation techniques to estimate the stock price to be 10 Egyptian pounds to 12 Egyptian pounds. So the investment bank has two options to set the final stock price and start receiving buy orders from the potential investors. The first option is to set the fixed price, say 11 Egyptian pounds per share, or to use a price range of 10 to 12 Egyptian pounds and announce this range to investors to submit their bids, in which each investor will specify the number of shares and share price he or she is willing to pay. After receiving the buy orders, the investment bank has two methods or mechanisms: the book building mechanism and auction mechanism, that can be used by the investment bank to find the final offering price and calculate the IPO proceeds and calculate the number of shares received by each investor. If the investment bank received five purchase orders from five potential investors, in each order the investor will determine how many shares he wants to buy and at which price. For example, investor A requested 3,000 shares and he is willing to pay 10 Egyptian pounds per share, while investor D wants to buy only 1,000 shares and he is willing to pay 12 Egyptian pounds per share. Okay, suppose that the investment bank wants to price the final offering price for each stock using the book building mechanism to sell 5,000 shares to five investors. So the first step in the book building mechanism is to build a book of orders and calculate the value of each order, simply by multiplying the number of shares times the share price specified in the order. So the market value of the first order, which is received from a bidder or the buyer A, will be 30,000 Egyptian pounds, and the market value of orders received from investor C will be 18,000 Egyptian pounds, which equals 1,500 shares times 12 Egyptian pounds, and so on. So at the end of the subscriptions period or at the closing date, the investment bank simply submissions the number of shares, total number of shares requested by all the five investors, and sum up all the total value of all orders requested by all five investors. Why? To ensure that the number of shares requested will cover the number of shares offered by the company. In our case, the total number of shares requested by the five investors is 10,000 shares, while the company wants to sell 5,000 shares. So it is good news for the investment bank and for the company, and this IPO seems to be successful. So the second step is to find the final stock price at which the shares will be allocated to investors. In the book building method, the final stock price will be calculated by dividing the total value of orders requested divided by the total number of shares requested. So we will divide 109,500 Egyptian pounds divided by 10,000 shares, which is the total number of shares requested. So the final offering price will be 10.95 Egyptian pounds per share. So each investor will pay 10.95 Egyptian pounds for buying each share. But how many shares will be allocated to each investor? Will investor A, for example, receive all the 3,000 shares requested in his order, and so on for investor B and C and D and investor E? Actually, to identify how many shares will be allocated for each investor, we want to calculate what is called coverage ratio. In our case, the total number of shares requested is 10,000, while the company will sell only 5,000. This means that this issue is called oversubscribed. Oversubscribed indicates that the number of shares requested is greater than the number of shares offered. By how many times? Actually, by 2 times. This is a coverage ratio. How we can calculate the coverage ratio? Simply, you can divide the total number of shares requested by the total number of shares offered. So 10,000 shares divided by 5,000 shares equals 2 times. This means this issue is covered 2 times by the investors. So this is rational that each investor will not receive total number of shares offered or requested in his order. So he will receive a percentage of what he or she requested. This percentage is called the pro rata basis. How we can calculate the pro rata basis is reciprocal calculations of the coverage ratio. So we will divide the total number of shares offered by the company divided by the total number of shares requested by the investors. So we will divide 5,000 over 10,000 shares, we will get 0.5, which means that in each investor will receive 50% of what he or she requested. For example, investor A, he requested 3,000 shares, but because this issue is oversubscribed, he will receive only 50% of what he requested. So 3,000 times the percentage of 0.5 equals 1,500 shares, and investor P will receive 1,000 shares. However, he requested 2,000 shares, but this issue is oversubscribed, so he will receive 50% of what he requested. And for investor C, he requested 1,500 shares, but he will receive 50%, so 1,500 shares times 0.5 will result in 750 shares. And for investor D, he requested 1,000 shares, but he will receive 50% of what he requested, so he will receive only 500 shares. And for investor E, he requested 2,500 shares times 0.5, so he will receive 1,250 shares. Okay, the final step is to calculate the total IPO proceeds or the cash flow from the IPO. So the summations of all shares requested must equal the total number of shares offered by the company. So if the company sell 5,000 shares at 10.95, so the company can raise 54,750 Egyptian pounds. So the IPO proceeds can be obtained by multiplying the number of shares offered by the company at the final offering price, which is 10.95. So the company actually raised 54,750 Egyptian pounds from this IPO. Second mechanism through which the investment bank can price the stock value in the IPO and allocate the shares to the investors is the auction method or auction mechanism. Given that we have 5 orders already submitted by 5 investors, in each order the investor specify how many shares he or she wants to buy and at which price. In the auction mechanism, the investment bank wants to sell the 5,000 shares, and he received 5 purchase orders. So the first step is to arrange these orders descending according to the price demanded by those investors. So the highest price is 12. The highest price is 12, and so we have two requests or two purchase orders received from two investors who want to buy shares at the highest price. The lowest price is 10. Price limit, the smallest price limit is 10. We have only one purchase order from investor A who wants to buy 3,000 shares at 10 Egyptian pounds. So the first step is to arrange descending according to the price level. So we will arrange the orders according to the price from the highest to move down to the lowest price. The second step is to calculate what is called cumulative shares at each price level, which means at the price level 12 Egyptian pounds, we have two orders, 1,500 shares and 1,000 shares. So this means the total number of shares requested at the price 12 Egyptian pounds will be 2,500 shares. But if the investment bank decides to set the final offering price at 12 Egyptian pounds, he can only sell 2,500 shares. But the company wants to sell 5,000 shares. So the investment bank must decrease the price per share from 12 to 11. So he will try to decrease the price from 12 to 11 to increase the number of shares he could sell. So at price level 11, he could or he have two requests, 2,000 shares and 2,500 shares, which equals 4,500 shares. But if he decreased the price from 12 to 11, he could sell 2,500 shares, which is requested already at a higher price, and more 4,500 shares, which already requested at the price level of 11 Egyptian pounds. So if the bank decreased the price from 12 to 11, he could sell 7,000 shares. But the company wants to sell only 5,000 shares. This means that not all shares requested by each investor will be received. We will use the pro rata basis to allocate the shares. But at this step, we want to set the final offering price. The final offering price will be 11 Egyptian pounds. So why this is the best price? Because at 11 Egyptian pounds, then the investment bank can sell the 5,000 shares. So the best price will be 11, or the final price will be 11 Egyptian pounds. This means that investor A, who already sent or submit order specifying 10 Egyptian pounds, which is the smallest limit in the price range, will not receive any shares. So investor C, D, B, E are called winning investors because they demand to buy shares at a higher price. But all those investors will pay the uniform clearing price, which is 11 Egyptian pounds. But how many shares received by each investor? We said before the total number of shares requested is 7,000 shares, but the company wants to sell 5,000 shares. So we will use a pro rata basis by dividing the number of shares offered over the number of shares requested. So the ratio will be 0.71 or 71%, which means that each investor or each winning investor will receive only 71% of what he or she requested. So we can we can use this ratio to find how many shares will be allocated for each investor. Investor C already requested 1,500 shares, but he will receive 71%. So 1,500 shares times 0.71 equals 1,071 shares. And by the same way, we can calculate how many shares will be received by investor D, who are requested 1,000, so he will receive 714 shares. Investor B will receive 1,428, and investor E will receive 1,785, which is calculated from multiplying 2,500 times 0.71. Of course, the summations of all shares allocated must equal 5,000 shares, which is the number of shares the company wants to sell. The final step is to calculate the Ipo proceeds from this IPO by multiplying the number of shares times the final offering price. Final offering price is 11 times 5,000 shares will equal 55,000 Egyptian pounds. So the IPO proceeds, or the cash flow from this IPO, equal 55,000 Egyptian pounds.